All right, we are keeping our eyes, of course, on the markets, and they are declining today. But let's get a up-to-the-moment take on what is going on. For that, Bob Iaccino is joining us. He's a market strategist at Path Trading Partners. Bob, I do want up-to-the-moment minute right now. What is going on? What's the driver to the downside? Exactly.
Well, earlier it was the global growth story. I'm sure you covered that already, so I don't have to go into that. But that excess selling off we saw starting about an hour or so was the U.S. cancellation of the envoys from China who were supposed to precede the trade envoys from China, supposed to precede the president, who were supposed to precede a deal. So essentially the background behind that is the U.S. has said they have not come with enough concessions in terms of the accused intellectual property theft, and they're canceling the meetings. Now, I'm sure that the administration will come out with a statement or a tweet or whatever's appropriate at the time to say the negotiations are still going well, but that's the excess selling that we're seeing with the equities on the lows right now.
And what kind of selling pressure did you see on the back of this news, the reports of canceling meetings?
Well, it was across sectors. I mean, we saw about another 0.5% in the NASDAQ. That's what took the brunt of it. The NASDAQ dropped down to almost 2.25% lower on the day. So it's pretty widespread in terms of where the selling is centered. In terms of volume, it's not the biggest volume sell-off I've seen over the last 16 months by any stretch of the imagination. So I suspect that there's going to be calming words, at least out of the U.S., potentially out of both the U.S. and China, and that at least that last half of selling would reverse. Still not going to affect the selling that we got from the 6.6% GDP, which was a disappointment from China and from the slowdown in German auto sales. And again, without good news on the trade talks, it all goes back to that geopolitical sort of dark cloud between the U.S. and China, and then you could throw the U.S. government shutdown in that as well.
And Bob, when you just take a look at the U.S. Economy and the earnings results that we're getting, let's talk a little bit about that, because if you go back even last year, other than December perhaps, so many investors were really talking about how the United States can go at it alone. The tariffs, trade war fears really don't impact the U.S. economy. That's kind of hard to believe given the globalization that's taken place over decades. But talk to us about what we did see in the economic data in the United States today, and then, of course, the earnings picture.
Yeah, well, we're seeing a slight slowing the board, but I think more important than the level of slowing that we're seeing is the trade talks are now sort of the excuse du jour. And I'm not saying that the trade war isn't affecting data. I'm sure it is. I'm not saying the government shutdown isn't going to affect unemployment and consumer spending. I'm sure it will. But it reminds me of the weather excuse that we saw 2-3 years back. I'm sure you remember, Catherine, where CEOs would come out and say we're affected by the weather. We're now starting to see, and Apple was kind of the canary in the coal mine for this, saying they've been affected by trade tensions and tariffs on China, when really Apple might have core problems that you and I talked about last week. So when you look at it from that perspective, we've got Davos going on, and I think those are the two key phrases we're going to hear. Pressure from trade wars and trade tariffs and the government shutdown are going to be coming out of CEOs' mouths. Now, right now, we've only had about 11% of the S&P report as of Friday, according to FactSet. FactSet has about 76% of the companies beating on EPS, but only slightly above 50% of the companies beating on top-line revenue. So it's real. Whether it's caused directly by the tariffs, which I assume some of it is, directly by tensions and lowered spending from the trade wars, which I'm sure some of it is, none of it can be from the government shutdown yet. How much of that is the global slowdown that's unrelated to this, and how much would be fixed by a trade deal? That remains to be the question. 11% is a pretty small data set in terms of companies that have actually reported already.
So how do you invest in this market then? I think that's the question, and for so many investors right now, obviously, in terms of perhaps looking for opportunities, and a lot of stocks have been beaten down and they have not been bid back up since the December time period. So what do you do? Do you actually go looking for bargains, or do you sit on the sidelines?
Well, I can only speak to how we invest, and this is it's going to be difficult for investors to replicate just from what I say to you. Before you went to my smiling face, you said that I'm bullish equities, and I am bullish equities. But what we tend to do is we look at companies that are at discount to forward earnings. A couple of examples would be Phillips 66, PSX, and Valero. I'm also bullish crude oil, so we have a crude oil position in the futures. But looking in terms of names and equities, which is what most people would play, I like those too. You've got PSX at about an 18% discount to 12-month forward earnings, and you've got Valero at about a 32% discount to 12-month forward earnings. Now, if crude oil continues to rise, that should take us up toward shrinking that discount, and preferably I'd like to own it before that happens, and I expect that to happen in the stock price. It could happen in a reduction of forward earnings estimates. That's where it could come in. And that's the issue. That's why at this point, from a cash standpoint, we're still about 70% on the sideline, but we have started to buy the stocks that we like. We have. It's more than we had in the market, even the last time I talked to you, which was last week. It's much more than we had in October and December of last year. 70%
cash you're at. That's a huge weighting towards cash. It's obviously been rewarded.
It is, but it's the reason we like days like today, because we are starting to buy things. The Phillips 66 and the Valero positions, we haven't done them yet. So that'll be a little bit more going into the market. If we have another sell-off, you get a little bit more going into the market. As the price of the stocks come down, we get a little bit more comfortable with the potential degradation of analyst estimates and companies' estimates on their earnings, because it'll increase our discount percentage and give us a little bit more room.
Okay, and just to be real clear here, just to kind of wrap this up, Bob, for our viewers, as you said, China trade talks with the United States, that was the big driver to the markets declining with the selling volume or pullback. But what I'm hearing, and you brought this up, it appears that Kudlow is going to be coming on one of our competitive channels very soon, like within the next couple minutes, apparently.
Yeah, a lesser channel, we can say that. Yeah, he's going to go on another news network.
Yes,
Sorry.
That's the word.
He's going to go on another news network, and he's probably going to be comforting. He's a very positive guy. I've met Larry. I've spoken to him. Positive guy. I can't see him going on a network and saying it's all breaking down. I doubt that's going to happen.
Okay, well, as we say that, we are actually off the lows of the day. Bob, we got to leave it there. Thanks so much for joining us, as always.
Good to be here, Catherine.
Thank you. Thanks so much. This is Bob Iaccino, market strategist at Path Trading Partners.